All right, let's dive right in. Today, we're talking about a massive shift in how American business works. Really, it's a battle between two big ideas. One about making things, creating real value, and another that's all about taking the value that's already there. So, to kick things off, let's look at a company you'd think is the ultimate maker, Apple. I mean, they're one of the most innovative companies on the planet. You'd assume all their big money moves are about funding the next big thing, right? Well, a few years back, they did something that made a lot of people scratch their heads. So get this. In 2013, Apple, a company already sitting on a literal mountain of cash, went out and borrowed $17 billion. Now, why would they do that? Not for a new factory, not for R&D on the next iPhone. Nope. They needed the money for what's called financial engineering. Basically, to buy back their own stock and give out bigger dividends to keep Wall Street happy. And that right there is the big question we're tackling. How did we get to a place where, for a company like Apple, making money through financial tricks became a higher priority than making actual world-changing products? When did that flip switch? To really understand what happened, we've got to break down these two opposing worlds, what the author Rana Foroohar calls the makers and the takers. The key concept here is this big, kind of clunky word, financialization. But stick with me, the idea is actually pretty simple. It used to be that finance, banks, investing, was like the plumbing for the real economy. It was essential, but it was there to help businesses get loans to build stuff and create jobs. Financialization is what happens when the plumbing starts to think it's more important than the house. Business isn't about building the house anymore. It's about making the plumbers rich. And you can see the two mindsets right here. On one side, you have the makers. They're playing the long game, investing in research, in their workers, in creating actual products. They see their employees as assets. Then you have the takers. They are completely obsessed with the short-term stock price. They use profits for things like stock buybacks to get a quick sugar high. And they tend to see their employees as just another cost on a spreadsheet that needs to be. So how in the world did we get here? Well, this wasn't some overnight thing. It was a slow, deliberate process of rewiring the entire American economy that happened over decades. Let's do a quick history lesson. For a long time after the Great Depression, finance was intentionally kept, boring. Think about the bank in the movie It's a Wonderful Life. It was a simple utility serving the community. But then, in the 70s, this new idea started to take hold, that a company's one and only job is to make money for its shareholders. The real game changer, though, came in 1982. That's when the government made it way, way easier for companies to do massive stock buybacks, something that, up until then, was basically considered a form of market manipulation. And that just opened the floodgates. Now, this new focus on finance was built on top of an even older idea, that workers aren't really partners in creating value, they're just cogs in a machine. This quote from Frederick Taylor, who's known as the father of scientific management, is pretty shocking to read today. But his whole philosophy, that the system is everything and the worker is just a component, really laid the groundwork for treating human labor as just another number to be optimized and controlled. Okay, but this isn't just some abstract economic theory. This shift from making to taking has very real and sometimes truly devastating consequences for all of us. Check out this number. Back in the 1960s, if you bought a stock, you held on to it on average for 8 years. That suggests you actually believed in the company's long-term future, right? You were investing in its growth. Now, fast forward to today. That same average is just 4 months. 4. That's not investing anymore. That's just high-speed trading, all driven by an obsession with next quarter's earnings report. The entire system is now built for speed, not for stability. And here is what can happen when that short-term, spreadsheet-driven logic is taken to its darkest extreme. With the Ford Pinto, the company literally did the math, a cold, hard calculation. They figured out it would be cheaper to just pay out settlements for the people who would be burned alive in crashes than it would be to spend the money to fix the dangerously faulty gas tank. I mean, when the balance sheet becomes more important than human lives, you know something has gone terribly, terribly wrong. And these are the results we're all living with. Just look at the disconnect. Worker productivity has shot through the roof since the 70s, but wages have barely budged. Companies are spending less on research and development, less on building their own futures. Those secure pensions our parents had, they've been replaced by riskier 401ks. And whole manufacturing industries have been hollowed out. This is the real-world price of putting finance first. Now, it's really tempting to just point fingers at a few greedy CEOs or Wall Street villains. But the problem isn't just a few bad apples. It's the entire system. See, this really isn't a story of good guys versus bad guys.
It's a story about incentives. When you look at the tax code, deregulation, the way executives get paid these huge bonuses, it all creates a system where leaders are rewarded handsomely for pumping up the short-term stock price, even if it hurts the company's long-term health, its employees, and even its customers.
This single sentence just absolutely nails the entire transformation. The real engine of the American economy has shifted from the factory floor and the research lab to the Wall Street trading floor. And so that leaves us with one final and really crucial question to think about. We've seen the short-term games, sure. But what is the ultimate price we all pay as a society when our economic system rewards extracting value more than it rewards creating it? That's the real bottom line.